All right, everyone, welcome to day 3 of Module 3. Today we're going to be talking about mutual funds and exchange transfer funds. And they're sort of the bread and butter for the casual investor like most of us will be. If you are going to save in a 401k, for example, without you knowing it, your money will probably be invested, or whether you know it or not, your money will probably be invested in a mutual fund or an ETF. So we're going to learn what those are. So this video is a good little primer to the lecture we're about to go through.
Diversification might be one of the most used and misunderstood words in investing. In this video, we'll discuss what diversification is and how you can use it to build your portfolio. Diversification is the attempt to reduce risk by spreading your investments across a variety of different asset classes, like stocks, bonds, and cash. The idea is that with the right diversification, some of the investments in your portfolio will be going up, while others are going down, giving you overall market returns and a smoother ride over the long term. In general, there are two main ways to diversify: diversifying by asset class and diversifying across investments. Most investors start by deciding how to allocate their assets among stocks, bonds, and cash. How you do this depends on your investment objective and time horizon. Generally speaking, the younger you are, the more equity such as stocks you should hold. As you approach retirement, you'll gradually shift toward more conservative investments like bonds and cash.
You'll be doing this in your workshop actually for this section, but as a young investor, you're able to tolerate more risk because if things go out of control, you have time to make it up. As you get older to retirement, notice what happens. The amount of stocks you hold go down into safer bonds and cash investment instruments that tend to have much less risk and be more secure because you're really going to depend on your investment during retirement for income.
One thing to note is that with interest rates at all-time lows, investors have been looking to alternative investments for higher returns and further diversification. Remember that the search for higher returns may mean greater risks and costs. Once you've decided on the big picture asset allocation, it's time to choose investments. You can further diversify the stock portion of your portfolio by purchasing individual stocks in a variety of market sectors, or by investing in a diversified basket of stocks through a mutual fund or exchange-traded fund. The same goes for bonds. E-Trade offers a full range of investment products across asset classes. If you work for a publicly traded company and hold a significant portion of your wealth in company stock, diversification is especially important for you. You may experience significant losses if your company fails to perform. Diversification may help you mitigate that risk while maintaining the potential for long-term growth. While diversification is important, you should not assume that it completely eliminates risk. It is simply the attempt to reduce risk by holding a basket of securities that behave differently in different market conditions. Also, diversification does not guarantee that if one investment goes down, another investment will go up. Risk is real, and diversification has its limits. Despite these limits, diversification is an effective strategy for long-term investors. To start improving your portfolio, first, try our portfolio analyzer to find if your
Thank you, E-Trade. Okay. So diversification is important, and that's where we start with mutual funds and ETFs. So what is a mutual fund, and why is it so important for the casual investor? Well, down here we have a diversified portfolio of securities. And so you, being an investor, might have $100. And you want to buy a diverse portfolio with it. And so you might want to buy all of these different securities that might be different across asset class, stocks, bonds, whatever, or they might be differ across sectors. So you might have one in transportation, agriculture, retail, whatever. But the problem is these stocks, let's suppose they each cost $100 themselves. And so as the individual investor, you actually cannot afford to buy a diversified portfolio. You can really only afford to buy this one stock, and we know that owning one stock basically subjects you to every type of risk that we talked about in investment. However, if a mutual fund, we might have 4 other investors that look exactly like you. And everybody has $100. And so on their own, these individuals can't afford to diversify. However, if you all pool your money, how much do we have? Well, suddenly, together, we have $500. And so we can pool our investment and we can afford this fund. And so that's where the idea of a mutual fund comes from, is that each investor buys $100 worth of the mutual fund. So a total of $500 of contributions. This entire diverse portfolio is then able to be purchased. And so when the stocks in this portfolio perform well, the investors each get paid back in proportion to what they invested to the mutual fund. So what would that be here? Well, right, each person is going to get 1/5 of whatever the profits are, which if you let me write pi as profits, as these things pay dividends, as these things have capital gains, the fund grows. And as the fund grows, you'll be compensated in proportion to your investment. So mutual funds allow the everyday investor to get into something that's very diversified for very little money. And that's not something we could do on our own if we didn't have a lot to invest. Now, how big are mutual funds exactly? These funds can have hundreds of stocks, like 300, 400 stocks within them that you and I could never, I won't say never, but most casual investors could never really afford that many stocks at a given time. But through giving money to an investment company who manages a mutual fund, we can get a hold of that investment, or get a hold of that nice diversification and good returns out of stock. So mutual funds, you buy them and sell them from an investment company. When you buy the shares of the mutual fund from the company, and when you're ready to sell it, you sell it back to the company. The price you pay is always the net asset value. And so the net asset value is the total market value of all of the securities in the funds divided by the number of shares outstanding. So if we have, for example, oops, that's terrible color. If the fund value is 100 million and we have 100 million shares outstanding, then that means what? The price of each share of the mutual fund is going to be $1 a share. That's going to be a pretty cheap mutual fund. How do you earn? Well, within that portfolio, all of the stocks are churning with the market. They're growing, and the companies are paying dividends, or all of the bonds are paying their regular interest payments. And so as those things are paid to the investment company who manages the fund, they are periodically passed along almost like a dividend to the investor of the mutual fund. So you earn a prorated share of the dividends, interest, and capital gains of the fund after fees. You can also get earnings from change in the share price. So, and when I say change in share price, I mean the mutual fund share. So if the total market value of the fund goes up while the number of shares of the fund outstanding stays the same, then the price goes up. So when you sell it back to the firm, you make capital gains as well. ETFs differ a little bit. So they still offer investors the ability to buy into a diversified portfolio that they couldn't otherwise afford. However, the way this works is, here's our 5 investors with $100. What the investment company is going to do is create a diversified portfolio of securities, and they are going to decide how many shares of that they want to offer, and they're going to list that on an exchange. So like the New York Stock Exchange is an exchange and the NASDAQ is an exchange. They're going to list the shares of this on the exchange. And investors then buy and sell with one another. They trade just like if this were a stock. So you can almost think about it as the investment company listing their own, like being publicly traded, right? The fund is a collection of stocks and it's publicly traded on the market. There's going to be some advantages here over mutual funds. One big one is, by trading amongst one another on the exchange, and not buying and selling from the company, you have a fixed number of shares, or in theory, you can have a fixed number of shares outstanding. And so you don't create as much, I would say, churn in the portfolio that might cause gains, losses, taxation. We'll talk a little bit more about that later. But right now, one broad statement I can make is exchange transfer funds are usually sought out for investors who want to get into a diverse portfolio with very low fees, very low cost. But they have sort of a different purpose. ETFs are purchased on an exchange. So if you want to buy an ETF, you can find it on a stock exchange. The price is going to depend on supply and demand. So what that means is, even though the initial price is that, if you allow me to go back, that net asset value, even though the initial price of the ETF would be the net asset value, depending on how the fund's performing, investors might sell it at a premium or discount to one another. And so the price doesn't have to be always the net asset value. Owners of the ETF, just like a mutual fund, are going to be paid periodically based on the dividends, interest, and capital gains in the stock fund, as well as if the price goes up, they'll have a capital gain. However, what's interesting is most of the ETFs you can buy into are index funds. And so what it means by index fund is the stocks are selected to index a certain segment of the market, and the fund is only managed to make sure it tracks that market. So here's some examples of ETFs and index funds. We have SPDRs, which are the S&P 500 index funds. We have the NASDAQ, which are called cubes, and we have the Dow Jones Industrial Average, which are called diamonds. So basically, what happens is these funds end up being really cheap for investors to own because the SPDR, for example, is simply all stocks in the S&P 500. The fund manager only has to decide how much of each stock to own to keep the portfolio tracking the S&P 500. Their goal is not to beat the stock market. Their goal is just to track it. Whereas a mutual fund manager might have a goal to get the highest return or some super high guaranteed or super high return. And so they're going to be really working hard to manage that account, whereas ETFs are not. And so that's part of the reason why ETFs have such little fees, is they don't have to be as managed as much. Okay, so here's a good comparison between ETFs and mutual funds. If I can get my mouse back, turn this off. So see what you can identify. Take some notes.
I'm Kevin McCormick of Kiplinger's, here to delve into what seems to be a never-ending debate among investors. Which is better, actively managed mutual funds or index funds? Here to make the case for actively managed funds, Manny Shifris.
When modern mutual funds were invented about 100 years ago, the point was to give individuals access to professional investment managers at a reasonable cost. When you invest in such a fund, you and a bunch of other investors are hiring a pro to invest your money. By studying companies and using a variety of strategies, fund managers and analysts aim to buy stocks in companies that will prosper, stay away from those that will stumble, and know when to sell to capture profits. And indeed, some funds produce astounding results. In 2010, for example, the Standard & Poor's 500 stock index, an off-cited proxy for the overall market, produced a total return of 15%.
So you can think of this being like an ETF. He's saying, okay, an index fund ETF only gained 15%, but this actively managed mutual fund.
But the best actively managed funds delivered far more. In fact, 170 U.S.-oriented stock funds produced total returns of 30% or more. That's the promise of actively managed funds, market-beating performance. If you have the time, interest, and ability
To select a group of funds with top managers, you can put together a portfolio that serves you very well.
Thanks, Manny. And now for index funds, Nellie Huang.
No doubt about it, Manny's right. Some actively managed funds beat the market, but the fact is, most of them don't. In 2010, just 37% of large company stock funds beat the return of the S&P 500 index.
So even though he identified 100 plus actively managed mutual funds that can beat the market, unfortunately, many of the mutual funds you pick that attempt to do it don't get there.
The rest fell short. So it's no surprise that in the 1970s, a new idea was born. Rather than trying to figure out which stocks to buy them all. Thus was born the index fund. An S&P 500 index fund, for example, owns every stock in the index. The computer program figures out how much of each one to buy, and the fund basically operates on autopilot. One reason index funds routinely beat most actively managed funds, in fact, is that running a computer is a lot cheaper than paying hotshot stock analysts. The average expense for a diversified U.S. stock fund is about 1.3% of assets per year, but you can buy an index mutual fund that charges less than 0.2%. The promise of matching the market might not make for exciting cocktail party talk, but if you use index funds, you won't have to invest as much effort in picking them, and odds are you'll beat investors in active funds anyway.
I hope this debate helps you decide which kind is best for your portfolio.
Okay, so let's go through some comparisons here between mutual funds and ETFs if you were to choose between the two. The first of which is ETFs allow you to be a narrow investor. So if you're a mutual fund, you're generally looking to achieve some broad goal. You're going to pick something that's very diversified and something that's going to safely get you a rate of return that you need. This should scream retirement savings for most of you. However, ETFs allow us to be narrow and a little bit more adventurous. So if you could buy perhaps an energy exchange transfer fund or a fund of a specific industry, and narrow down on that particular sector. When it comes to taxation, mutual funds are actively managed, which means the managers of these funds are going to be selling and buying stock within the fund to continue to try to beat the market. And every time they sell a stock, of course, they might be selling it at a gain, and that has capital gains taxes with it. So you'll be taxed on when they sell that stock. You're on the hook for that as the mutual fund holder. Additionally, when other fund buyers, when other holders of mutual fund shares sell their stock, the managers of the mutual fund have to reduce the number of stocks in the portfolio, and doing so can also kick in capital gains. So you're taxed more often with a mutual fund. With an ETF, these things are passively managed, right? You usually pick a portfolio stock and kind of leave it be. And so since they are so passively managed, they're not going to create as much capital gains, and you're going to be tax less. You'll have taxes deferred until you actually sell the share. And then, of course, when it comes to cost, this is one of the major differences. That active managed portfolio, well, you're going to pay for it. And so mutual funds have a lot of fees, and these fees are called loads. So let's take a look. Let's take a look at some of these loads in action. So here's the Wall Street Journal once again, and now we're looking at mutual funds. And so when you see a particular mutual fund, they're going to have abbreviations for what type of fund they are, and it kind of depends on the company. But you'll see after them a P, an R, or a T. What P stands for is it tells us the fund has an annual fee applied as a percent of assets managed. So it's usually less than 1% of the entire assets that you have them manage. This is called the 12B1 fee. That's what you read about in the book, the 12B1. But P stands for an annual fee you pay every year holding the mutual fund. We go down here. I didn't see any R's when I was scoping this out earlier today. And I still don't. There's an R. So here's a fund with an R. R stands for a redemption fee. And this is when the fund is sold. When you sell it back, you're going to pay a fee. And that's called a back-end load. So you'll pay a fee on funds that have an R at the end when you sell it versus an annual fee. And then a T means the fund has both. So you'll pay an annual fee and you'll pay a back end fee. The other type of fee you might have is called a front end load. You'll just have to read and see if the stock has it. But basically, this is commission charged when you buy the share. So 3 types of fees that you pay, and what that's basically paying for is your quote unquote hotshot analyst to manage the fund. ETFs, like I said, passively managed, so they're going to have less fees. They do trade like stock, right? They trade on the stock exchange, so you're going to pay broker fees when you buy the stock, but you're not going to encounter the fees of managing the fund because they're kind of like a set it and forget it sort of thing. The last thing to talk about is types of funds. So I want to be clear here. There are perhaps infinite types of mutual funds and ETFs. And that's because you can combine an infinite combination of asset classes and an infinite combination of stock within each asset class, or bond within or stock within the stock asset class and bond within the bond asset class. But there's some broad ones I want you to be aware of. These 3 in particular, because you are going to be finding out whether your characteristics as an investor match to you having an income mutual fund, a balanced mutual fund, or a growth one. So let's take a look. Income funds. Income funds are for the income-oriented investor. They have minimal risk, and it's because you expect a modest growth in the fund. You don't really care about the price of the index going up or the fund going up, but you care about them paying you timely income streams. And so this has a short investment time horizon. And so what would you picture something that had that was more income oriented and very low risk? You would picture it having lots of bonds. And you can see here we got a 100% bond fund, an 80% bond fund, and a 70% bond fund. Then the next type we have is a balanced one. Just like it sounds, you balance the amount of stocks and bonds you have. Typically, these are going to hold about 30 to 40% bonds. And the idea here is you're not a very risky investor, but you want some growth with the stocks. So you're going to tolerate some volatility in your investment, but balance it out with a healthy dose of bonds. And so down here, we see here a 40-60 stocks and bonds fund, a 50-50, and a 60-40 stocks and bonds fund. And finally, down here, if you want growth, you don't care about current income. So somebody who's in their retirement should have something that looks like this because they want to get paid in retirement. They're not concerned about growth because they're at the end of their life. Whereas somebody who's young in their life is probably going to want a lot of growth to get their retirement savings up. And so what we see here out of these growth-oriented investors is they care about the long term. They don't care about dividend payments or income payments, but they care about the fund just growing. So these are mostly stock funds. The one thing I want to point out is look at the different interest rates. Bond funds are going to gain about 5 to 7% historically on average. So this is a wide range, 26 to 2015, but on average, this is what we get. If we add in a bunch more stocks, we get up to 7.8, 8.7 average annual return. And look what happens when we get down here to growth. 9, 9.5, and 10. However, remember how I said you have to tolerate market volatility? The fund has been its worst at 43.1% negative, and its best at 54.2% annual return. These bond funds, nowhere near that fluctuation. Best year, 32.6, worst, negative 8.1. There are many other types of funds you can get into. I encourage you to read through your book just to see what the different types are. There may be a few homework problems over them. But again, what you will be doing in your workshop is selecting a mutual fund. So the way you're going to do this is you're going to start off by filling out a little survey that's going to help you calculate your optimal asset allocation. Once you've figured out that asset allocation based on the parameters you fill in, you're going to go select your mutual fund. And once you find out what your mutual fund is and what your average annual rate of return looks like, I want you to go back to think about your retirement calculation and readjust based off of the interest rate that fits you, not the one that we used for the workshop at that time. All right, guys, that's short and sweet. That's mutual funds. Real estate is at the end of this chapter. Don't study it. Don't worry about it. We're not going to cover real estate.